All right, how's it going? So, one of the most commonly asked questions that I get is how do you underwrite a deal? I built the spreadsheet to help other people analyze the deals, but they want to know how I use the spreadsheet to underwrite the deals that I look at for myself and for my partners. So, this video is going to hopefully kind of show you a little more quickly in a little bit less detail than I would normally go into, kind of how I use the spreadsheet to underwrite deals. And what I'll do is I'll use a deal that I've looked at in the past that I kind of modified to keep some specific information out of it, and maybe to illustrate some points, but just to show you kind of the process I use. So, just to set the stage a little bit, uh, let's just say that this is a high six, low seven cap market, and the broker described the deal as having an aging owner who's kind of let the property slip into a little bit of a state of disrepair. You got maybe lower rents that haven't been raised in a while. So you've also got some vacancy because the units have kind of been let go, and they're kind of nasty little units. Nobody wants to really live in them. And then you also got high expenses. So it's trading at a 2.14, which is an advertised at 7 cap, based off of the broker's numbers. So we'll take a look at that in a minute. And it's 20 units, so $107,000 a unit. So maybe it's a little unrealistic for what you'd maybe expect to see in a high six, low seven cap market, but we'll just let it slide. So, using MogulTool, you can incorporate either traditional debt, you can assume a loan if that's an option, or you can incorporate seller financing or mezzanine debt. For this one, we'll just incorporate a traditional loan, and we'll let kind of the standard loadout be what we underwrite with right now. But you would definitely want to check that with a lending partner before submitting any offers, or getting too far into this. But we'll just use 75% loan to value, 4.5% interest, no interest only, 10-30 term amortization. And then now on the dashboard to get moving along, you would also want to put in your business plan, which in terms of kind of what your expected timeline and horizon is for the duration of the hold. You can incorporate a refinance if you'd like to. We're going to keep things simple by not putting in a refinance, but it is an option. Let's say for the sake of this deal, we'd want to dispose of the asset at year 7, and because we said it's a 7 cap market, let's just put 7.5%. We'll add a little bit of a buffer, assuming that maybe the market will kind of cool down a little bit over the next 5 to 7 years. So we'll put 7.5%, and then a sale cost of 4.5%. The reason why there's 2 cap rates right here is because in the tool we have a weighted model where you can kind of do some stress testing on it. But we'll again just keep things simple. But just if you do have the spreadsheet, it's always an option. So okay, so that's basically everything that we're going to do on the first page on the dashboard. And the rest of the analysis is going to take place on the financial analysis tab. So the financial analysis tab, it looks a little bit busy. Normally everything would be zeroed out, but basically what it is a structure that allows you to simply analyze all of the different materials that you're going to get when you're looking at a deal. So I've already gone ahead and put everything in. And I'll explain kind of how I got the numbers, but let's just start in this first column right here. So only focus on this column. So this is the T12. This is the trailing 12 numbers. Basically the last year's operations kind of pulled into one. It's in this case, we'll just say that these were the numbers that they gave us, right? So they had a gross income of $200,000. Maybe there was a lot of vacancy at the property. This is what it should have been. This was the vacancy that was accounted for. We already did the analysis. They had some bad debt, and then they had $5,000 of other income. Let's just say it was from laundry and garage. They also had these other expenses. All right, I'm not going to go through them individually for sake of time, but they had pretty high expenses. Let's say it was $4,700, and maybe in this market, the average was between $35,000 and $4,000. $3,500 and $4,000 per unit per year. So this place is operating at high expenses. So they had an NOI of $80,000, which at the purchase price of 2.14 is a 3.76 cap. At a 7 cap, it would be a 1.15, right, which is what it's being advertised at, is that 7 cap. And if we go to the OM and broker pro forma, these were the numbers that the broker provided, right? So he thinks that we're going to get $200,000. That's the base, and then we can also incorporate $40,000 of premiums, and then he's underwriting $10,000, so just under 5% of economic losses, no additional other income other than what was already existing, and then the expenses were slightly lower. Which, as you can expect, the broker's job is to make this deal look as attractive as possible. So already you can see that he's almost doubled the NOI at purchase, which, if you look at it relative to a 7 cap, is where they got that $2.14 million asking price from. So, basically what I look at is these two numbers are simple, copy and paste it directly from the OM, or the provided materials. There's not much analysis that needs to go on there. Maybe you can make some notes of things that you see, maybe if anything sticks out. I would say one of the things that sticks out to me in this is that this seems like a very unrealistic jump. And I think, just depending on the market, maybe it's not so unrealistic. Let's just say for this market, this is ridiculous. There's no way that would ever happen. And I can't think of any markets where you would see that large of an increase in 1 year. So let's just say, that sticks out to us. The other thing that sticks out to us is that $40,000 is a very large rent increase. And we could do an analysis really quickly to show you how much the $40,000 increase is. But I'll show you how MogulTool makes that easy. But how we want to look at this is, realistically, where you're going to be able to operate the property is somewhere between these two numbers. Now, if you want to get a third look at, where you think the kind of the truth sits, where you're going to be able to find the best, business plan, what it's going to look like, is having, a property manager or getting a third-party report. So either from an underwriting consultant or, maybe maybe you just have a partner who's good at underwriting. You want to, but is in a different market, and you just want to get their 2 cents. This would be where you put their report in. So most property managers are happy to provide you some form of, they're happy to provide you some form of a pro forma for a property, provided that you have a good relationship with them and they know you're not just wasting their time trying to get information out of them. So, this is from the broker. So these numbers are going to probably be unrealistic, and they're going to show you an NOI that's too high. And in my experience, when you ask a property manager to put together a pro forma, their numbers end up coming out probably lower than where you could expect it to be. Because, listen, they're a property manager, and while maybe they have a good idea of how the property is going to run, their whole goal is to underpromise and overdeliver, and they don't want to make any promises that they're going to be able to pull in amounts of income or cut expenses that may not actually happen. So usually they will, they'll provide you a pro forma, but you can't just take it for exactly as it is. You probably want to look at their numbers, because this NOI that they give you might actually be lower than you probably could underwrite. So it's not just about taking the lowest number. It's about taking the most precise number. And so let's say that you get a property manager that says that you're going to, you're going to make more than the T12 is making, right? This $204,000 is more than the T12, but significantly less than the broker's numbers. And then your expenses, when it's all said and done, is definitely lower than the T12, because they're not operating it very well. But it's still higher expenses than what the broker was saying. And then what the NOI comes down to is 116, right? So now your job is to find out kind of where the truth sits, right? So the first place that you can kind of start is in the rent roll analysis. So we have a nice little window for you to input the units into the spreadsheet. In this case, what we'll do is the unit breakdown. So what we'll do is we'll just put all of them and just treat them as if they were all two bedroom, one bathroom units, 800 square feet, 20 units. They're 830. We know that they're 830 because the gross income on this other property after the analysis we did was $830 per month. So let's say it's 830, and then we think that based off what we heard from the brokers or from the property managers and maybe the broker even a little bit, that $100 bumps is probably more realistic than whatever the broker was saying. So what that says is, we could theoretically, this rent premium is worth $24,000. That's the gross value of it. And what we want to do is we want to schedule that out over 2 years. We're going to raise that rent by over 2 years. And so the way that's going to work is in the spreadsheet, we're going to use the same basis, right? Which in this case was $199. That's our current unit rent, $199,000 a year. We'll just round it up to $200,000 for simplicity. And then the spreadsheet automatically populates in the value of the rent addition based off of the rent schedule that you put in. So we put in 50% the first year, 50% the second year. It's going to automatically take that $12,000, put it in. We'll put in our own economic losses, we'll put in our own income. And one thing you might notice is that we have additional other income right here. So, the broker didn't say anything about this. They didn't think about it. Let's just say they didn't think about it. But the property manager, when they did an analysis of it, they said, hey, look at all these utilities that they're paying. We should bill those utilities back to the tenants. And so they say, hey, we're going to still pay for those utilities, but then we're going to bill them back. And so it'll end up cutting out. And so we'll incorporate that number into our model, which is going to help boost our NOI. And it's a smart business play, and it's a business play that a lot of companies are starting to use, but you do have to make sure that market will allow it. Some markets, it's still normal for the owners to pay for their tenants' utilities. So let's just say at the end of the day, when it's all said and done, you now have a realistic income, a realistic operating expense, and your NOI now is kind of right where you want it. It's higher than the T12, it's lower than the broker's numbers, and it's also a little slightly higher than the overly conservative property manager numbers, right? Because remember, the property manager is a little overly conservative, trying to underpromise and overdeliver. So this number is kind of right where you want it. Now, that being said, if we were to buy it at $2.14 million, we'd still be buying it at a 4 cap, which this market is not a 4 cap market, so we're not going to do that. And at a 7 cap, we'd be at a 1.7. So all right off the bat, if we wanted to stop right here, we could. We could go back to the broker and say, hey, listen, I did a quick analysis. This is what I came up with. You're saying it's a 7 cap valuation. This is kind of how my numbers penciled out. I think I could offer 1.7. Now, most people wouldn't feel comfortable offering from right there, so we can talk a little bit more about kind of what the next steps would look like. The next place to go would be the Sources and Uses tab. So the Sources and Uses tab is going to start incorporating the different costs that go into buying a property. So it's not just the purchase price, right? So the purchase price only makes up a portion of the total project cost. You also have capital expenditures and closing costs, which are made up of, the actual closing costs themselves, reserves, and your fees. So we're going to leave everything just the way it is right now. I kind of went in earlier and set these things up, and you can go ahead and pause the video if you'd like to kind of look through some of those costs. Some are probably a little high and some are others are low. But the one thing that I want to draw attention to, I think it's a wash probably, but the one thing I do want to draw attention to is this operational reserve. So it is absolutely recommended that you set an operational reserve and you set and forget. And depending on what your own risk threshold is and what your capabilities are in terms of bringing an operational reserve to the table, you might want maybe 0.4, maybe up to 0.5% of the total cost worth of reserves, or maybe you want 3%. It depends. So you need to do, kind of question your own risk threshold, or your investor's risk threshold, and what kind of reserves you want. Because, you look at times like now where things are a little bit, things are getting a little bit squirmy. It's probably a good idea to have some reserves. So it's just a question you need to think about. This is where you'd put those reserves in. Now, as far as capital expenditures go, let's just say that we also, we know that this property is in a little bit of disrepair and we don't know what we need to work on yet, but we want to incorporate something into the numbers, into the offer. Let's just put a blank Capex item across the 20 units. We'll put $2,000 a unit. So we're going to need to bring $40,000 in Capex. So that brings the total project cost as it is right now to $2.25 million, so 2.25. Now you can look at the breakdown, the sources, and then what the sources are made up of right here. And then we got some ratios to look it over. Now at this point, we're basically done with inputs. We still have some fine tuning to go, but as far as the actual financial inputs go, we're probably right about where we want to be to kind of get that first initial number out there in terms of what the property's worth. So, if you wanted to, what you could do is you could adjust the rent growth and expense growth to match your market. I found that 3% growth for rent and 2% expense growth is usually a good place to start, but that's something you probably want to confirm if you don't know it for your own market, probably with a property manager. And this is that 3%, just to be clear, is a breakdown of that $200,000. So that $200,000 basis, and then the spreadsheet automatically populates in that total rent growth that we had scheduled in by year 2, right? Remember, we did 50% the first year, 50% the second year. That's $24,000 total. It incorporates that and then grows it at 3% or at whatever number is set right here. And it'll automatically incorporate that. Now, if you click, you'll see it's not just my version. Every version of MogulTool, everything is completely unlocked, and there's a reason for that. This is not a calculator; it's a spreadsheet. And so, as much as I believe that it's pretty easy to just put all the numbers in, and if you just use it, straight out of the download, you can get good results from it. My goal is that you also have the flexibility to kind of make additions to the spreadsheet as you'd like. So that's the reason why you can still click and see all this stuff. Is so if you ever are questioning like, hey, like where do these numbers come from, you can double click in and see kind of what the breakdown is if you're able to decode it. So it's a fairly dynamic spreadsheet, but also has some ability to kind of be made and customized into your liking. So it grows. Let's just push on. So this is a pretty normal pro forma. There's a return breakdown, which already we're looking at. If you go to the return breakdown, you see a lot of red, right? Which is kind of indicative of what the numbers look like at the current offer or at the current asking. But you can kind of break down the numbers, and again, feel free to pause the video to kind of see like how the numbers work together. And then on this last page, a summary of cash flows, you can kind of visualize where the money goes at the key points during the acquisition. So in this case, at year 7, there's going to be an NOI of 160. That's based off the pro forma. Or it's going to sell at the cap rate that we set at the beginning. That's the valuation. Here's the return of your reserves, if there are any reserves remaining. And basically it breaks it down and it says, hey, here's the proceeds from the deal. And that's incorporated in the return summary. Okay, so we made it all the way through. We've set our numbers and we feel good. Let's just say, we kind of went through this pretty quickly, but let's just say we're very happy with this offer model. And we really believe that this model that's feeding the rest of the spreadsheet is the NOI that we want to base it off of. So we're happy with the number, but we don't like this 2.14. These are the numbers that are these are the actual returns that we're looking at right now. So they're not great. And then we have these return hurdles that we can set. And what we're going to do is we're going to set these return hurdles we're going to line them up with what we want to see out of a deal. And then we're going to use these buttons to start to kind of work on this price and figure out what the ballpark we can expect is. So let's say 20% IRR, 10% cash. We're going to want an equity multiple of maybe 2 in 7 years, and then a payback period of, I don't know, let's say 4 years. And our desired purchase cap is going to be a 7%. So if we wanted to buy it at a 7 cap based off the T12, we would have to buy it at basically 1.161. So we're already very much below what they're asking us. But let's try and work with these other numbers. So our IRR of 20%, that'd be 1.46, 1.47. Cash on cash would be 1.87. If we were going to base it off the equity multiple, 2.0, that's 1.6. And then our payback period would be basically 1 million, which is not great. Maybe if we did 5 years, that'd be more realistic. So 1.2. So we're basically between 1.2 and 1.8. In other words, the broker is probably not going to be happy to hear that, but based off the numbers that you set, you did your own analysis, you came up with an idea of what it's going to cost for you to run this property according to your business plan. These are the numbers that make sense. So, that's that's the point where like now, you go to the broker and say, hey there, Mr. Broker, Mr. and Mrs. Broker, we like your deal, but here's the numbers that we used and kind of some of the assumptions we made. We didn't get close to your 2.14. We don't want to waste your time or the seller's time. So, if you want us to submit an offer, no worries. If not, however you want to phrase that conversation. But you now have a price point that you can come from, and not just a price point that you can come from, but also a justification of how you got there. And believe me, if you just take a screenshot of the pro forma, or you take a screenshot of your year one, or you take you don't want to forward this to them probably, but if you give them a good idea of how you came up with your numbers, there's not going to be much that they can say in terms of, well, you probably overstepped here, or whatever. So my recommendation to you is to either figure out a way for you to kind of so as far as to answer the question that they said, how do you underwrite your deals and how do you do it quickly is kind of like the next thing is like, how do I do this not just once a day or a week, like how do I do this multiple times a day? And the answer to that question is pretty simple. So either create a spreadsheet for yourself or get access to a tool that can help you do it for you. MogulTool's whole thing is that you can just absolutely bust out a whole bunch of different analysis of different properties, and you don't have to worry about accidentally messing up your template spreadsheet, because you can always just download it again, which is nice. And if you have any questions, you have access to a support team of underwriters and developers who know the spreadsheet inside and out and are there to kind of help answer your questions. And also the networking component of it. So if you find a deal that you like and you want to get some professional advice, being a part of that community is pretty helpful. So needless to say, there are a million different ways to skin that cat, but this is the way that I would go about kind of doing the quick and dirty 20-minute analysis. So I appreciate you hanging in there with me. If you got any questions, please comment below or shoot us an email at support@mogultool.com. That's that email right here, and I'll put a link to it in the description. So have a great rest of your day, and please reach out if you have any questions.